Good afternoon, everybody. Welcome to our afternoon. This is a special edition of Coffee and Crypto Live. It is Wednesday, the 21st of September, and the reason we are here live is because of that FOMC meeting. Now, I know we are live. We have not gotten those numbers yet, and I got T-Shroom hitting some buttons, refreshing his page, because I know those are just now out. Have we got a number yet?
We got him.
We got it. What's the number? Oh, by the way, Caleb Franzen's here. I'm gonna show
What's the number?
Caleb
What's the
Franzen.
number?
What's the number?
75 bips.
All right. Well, just as predicted, as the doctor ordered.
Just as the doctor ordered.
It is. But here's. I'll give you T-Shroom. So before we go, let me stop. I'm gonna stop right here. T-Shroom. Let's introduce T-Shroom.
Ooh. I feel like you speak a little more.
Bitcoin is extremely volatile right now.
Don't worry about it just yet, T-Shroom. We'll cover the price action here in a second. T-Shroom,
Look
go
at
to
the
his
charts.
screen real quick.
Look at
This
the
is
charts.
T-Shroom just watching the charts.
Bitcoin just dumped 800 bucks.
It's okay, guys.
Oh.
It shot up and then dumped.
All right. They got T-Shroom. Smay. Go to Smay. You guys know Smay.
Oh.
You can come back to me and you go to my chart real quick. You guys are looking at Bitcoin right now. After we literally just had the last minute be extremely volatile. We shot up over 19,800 and now we're back down to about 18,900. We're kind of fluttering right there below 19,000. There was a question I asked the guys right before we went live. And this is what we're going to discuss what this means. 75 basis points was baked in. I'm just going to say it. We knew 75 was coming. We always get volatile right around these moments. Watch the price get volatile again when Jerome Powell goes live here in about 30 minutes. But here is the question I want everyone in chat to answer. And I know we already gave our answers, but you guys will hear them. I was being nice at 3 p.m. today. So that means we've had the numbers now for a full hour. Jerome Powell gets to speak. We kind of have a good understanding of what he's saying. I'm giving us a price of 19,800. Do you take the over or do you take the under? T-Shroom, what do you got?
I'm going to take the under.
You're taking the under. So you believe will be less than 19,800?
Yes.
All right. Smay, what do you got?
I'm going to say I'm going to take the under as well.
Under. You think we're going to be lower. That's
Yeah.
That's really nice. We didn't get your answer beforehand, but you're going to go. That's fine. I'm going to stick with mine. What about you, Caleb? What do you got? Over or under 19,800?
Well, when it was just us before, I said over. So
You
I'm
did.
going to have to stick with that just to be consistent and keep my integrity high. But seeing price right now at basically 19,200, we'll see how it shakes out. And the Powell press conference is going to be even more fireworks, in my opinion. So.
I got good news for you here,
This is
Caleb.
awesome.
This is what always happens. We always freak out right at 2 o'clock. We always freak out at 2:30. The price is going up. 75 was baked in. 75, and I'm not saying we're shooting back up to 25,000. I'm not saying that 75 is this massively overly bullish thing. But go to my screen here, Smay.
Well, before I say that, can I say something real quick? You and T-Shroom are matching right now.
We are. He got cold,
Yeah.
I think, or something.
Okay,
I don't know.
but anyways,
I
now
legitimately
I'll
got
go-
cold. This
Yeah.
is only hoodie.
We have been dropping. So we got up here around. We got above just to 25,000 back here on the 14th of August, but we have been working down. We did have a little pump back up to about 22.7-ish, almost 22.8, and then we came back down. This is all in anticipation. This has been a roller coaster of emotions. We dropped when it really looked like 75 was a real thing, right? And then 50, there's a lot of people pumping 50 mindset. Right around this time in September 6th, some people were saying, all right, maybe we're going to get 50 or maybe one word pump before that 75 comes into play. 100 became a real thing right here a week and some change ago, or I guess like 2 weeks ago at this point. 100 became a very real possibility, and we've come down because of it. There was fear. At one point, we had 30% of people who were predicting what it was going to be, saying it was going to be 100. Even on polls we gave this morning on my Twitter, yesterday on our live stream, we had over 30% of the people saying they thought that 100 basis points was going to be hit. It is 75. I think this downward action has been priced in. The reason we're not exploding right now, and I'm going to get your guys' take here in just a second. The reason I don't think we've gone up is because, all right, we're hovering. We had a little pump. We had our little fall. Volatility comes. We're waiting for what Jerome Powell says. Yeah. And I'm still predicting that Jerome Powell is going to come out and act like he's this knight in shining armor, that 75 is the new 25. He's got it under control. We don't need to freak out. Don't worry about that 100 basis points. That is an evil that we do not have to deal with. We can stay at 75 basis points for the next 3 meetings and still be good. That is why I think at 3 p.m. we are going to be over that 19,800. But I'm going to throw it to you first, Caleb. What is your thoughts about just that? What is your thought about this price action we're watching right this second? And what do you think Jerome Powell is going to be saying here in about 25 minutes?
Well, considering the fact that before the results had just come out and been published, the market was basically expecting an 82% chance of the Fed raising 75 basis points and basically an 18% chance of doing 100 bips. I'm actually quite surprised to see that we aren't seeing more upside momentum right now. And if anything, we're seeing downside momentum, right? That 18% likelihood that the market was pricing in for 100 basis points should be working in favor of risk assets, considering that we're only getting, quote unquote, only getting 75 today. And so I think I'm a little bit surprised to see the immediate market reaction. I'm not at all surprised to see the dollar moving higher, 2-year yields moving higher, back above that 4% range, which is extremely important. So I think that's my first kind of takeaway in terms of the market reaction specifically. And then I think, I mean, you hit the nail on the head. This has been the big theme that I've been talking about for the majority of the year, which is that in reality, the Powell press conference is probably going to be more significant than the rate in and of itself. We haven't gotten any real surprises in any of these policy decisions. Basically, market expectations are exactly what ends up happening. And so Powell's press conference is really where investors are going to have the ability to look into more of the Fed language, expectations, and obviously we get the ability for reporters to push Powell on certain points and to perhaps clarify his perspectives on certain economic data points. So that's what I'll be looking for.
Yeah. What about you, T-Shirt? What are your thoughts? I know, again, you're taking the under on this one.
Yeah.
Why do you think we're going to stay below?
Why do I think we're going to stay below? Because I think that, there's a couple of different reasons. The biggest one is in the past, on the Fed day, it gets bought up until the data drops, and then the data drops, and then from there, it gets really volatile, and then when he starts talking, it starts to sell off. And then the next day, it really sells off. And so when he's talking, it sells off the gains of the day, and then the next day, it sells off. And I'm talking about the last 3 rate decisions that have been 75 basis points. Or the last ones that were 75. So that's why I think it's going to go lower. By 3 o'clock, it will be lower, in my opinion, than 19.8 because it's going to sell off while he's talking. That's just because that's what I think.
I hear. I told them because literally about a minute before we hit live on this is when I found out that T. Shroom is this bear. And that
I'm a bear in the 3-day span.
He thinks that with 75 basis points we're going down, and I'm like, man, the next video we're gonna have some fisticuffs here in office. Here's what I'm gonna get back to, and I've said this in other shows, and I'm gonna say it again. I don't understand your rationale here, T-Shirt. The reason being is that up to this point, 75 has been a bad thing. 75 basis points has been this. Wow, we haven't had 75 basis point interest rate hikes for 40 years. Like, this is crazy. 75, though, between this one and the last one, became the new 25.
Yeah.
And so we knew that 100 would carry the same type of like what you just said, that after we get these 75 numbers, the market ends up dropping the next day.
Yeah.
That would have happened if 100 happened, because 100 is the new 50. And at one point, believe it or not, earlier this year, 50 was aggressive and was hawkish and was terrible because Jerome Powell almost led us to believe that 25 was going to be the norm.
So I guess I hear what you're saying. Logically, it doesn't make sense. But the thing is that Bitcoin traded higher today, this morning, leading up. Yeah, and that's why I'm thinking it's going to – that's why I took it. The elephant in the room here is I took a short position. I bought some BITI. I bought BITI, the ETF, in anticipation for this. It's not a big play, but it's it's just to kind of play this moment. So that's the elephant in the room. Why would I do that? I bought it because it's overbought for this moment. I think that the Bitcoin's going to sell off over the next 3 days because of what Jerome Powell's going to say, not because of the data drop. The data drop has come in exactly what everybody thought, and now it's selling off in this moment, like literally, in the minutes leading up to the press conference because of what he's going to say, and also because if you go to my screen, all of this data. So this is all the PDF for the summary of economic projections. So right now there's all these quants and all these people doing what Caleb used to do, and I'd love to get your input so far on what these summaries are telling you, Caleb, if they're telling you anything But there's all these people right now in financial institutions poring over this, and their algorithms are pouring through this data, and they're making their bots are probably trading on it in real time. But they're seeing, is what the Fed looking at, is that accurate to what they've been looking at? Does the Fed's models match their models? And so they're digesting all that right now. And so it's in the moment, it's anybody's call of which way the market goes. And so I just took the position I took, and that's what it is.
I want to get Caleb to chime in back here in just a second to deal with this back and forth. I'm hearing you. I'm hearing you. Here's just the whole thing is that I feel like every single time Jerome Powell has had to come out after the announcement of 70 basis points, it's like his heart sank. Like he felt like a failure as a leader and a failure as a person. He hated doing it. For the first time this year, he had the option between a very, very bearish one, which was 100, and then we're viewing 75 as like that's what our options were. Our options were bearish or bullish. That's why the price dropped. That's why we went from 22.7 down all the way to 18,000, because the price knew, the market makers knew, hey, we got a high interest rate coming. Let's prepare ourselves, right? And a bullish scenario will be 75 basis points, and a bearish scenario will be 100. But let's go ahead and drop down low just in case. And now that we got our 75, I think, again, Jerome Powell, for the first time in months, is going to feel like he actually did something bullish. He actually did something that could help the economy. He actually did something that by keeping it that low, that he actually can stand on a little soapbox and say, look, guys, I got it under control. We're not going crazy. The sky's not falling. 75 is good enough for now. And I know I saw someone in chat say it's not the new 25. For now, 75 is the new 25. I'm sticking with that quote. Caleb, chime in on that. T-Shum and I are here. We're about to jump over these desks. And
Tim is upset.
I'm very upset.
I don't feel like I'm taking.
I feel hurt. I feel betrayed. I feel betrayed by you, T-Shum, and I need Caleb to console me. All right, Caleb, what do you think?
Well, I want to go back to T. Shroom's point about the summary of economic projections. And I want to share my screen just really quickly here so that we could go over some of this data. And specifically, what I'm looking at right now is the PCE inflation, which they expect to be 5.4% at the for 2022, and next year at 2.8%. I couldn't remember right off the top of my head. This is the Fed's preferred measure of inflation, but they don't target this, they don't target the 2% for PCE, they target 2% CPI, right? So this isn't their policy metric, but it's certainly one of their preferred tools for measuring actual levels of inflation. If we go to the PCE on a year-over-year basis, for the month of July, it's at 6.3%. We're going to get this update in probably a couple of months, or sorry, in a couple of weeks here, maybe in just a week. But the thing that I'd like to point out is it was at 6.3% for the month of July, which was down slightly from the month of June. But over the course of July to August, we saw alternative measures of inflation like median CPI, trimmed mean CPI, sticky price CPI, all accelerate higher on a year-over-year basis from July to August. So when we look at the PCE right now, we can see that it's historically elevated, right? The last time we were above 6 was back in February of 1982. And obviously that was when we were in a falling CPI environment in terms of the rate of change. But this is very key here because the Fed is saying that they expect it to be 2.8% this time next year. Versus right now it's at 6 point. So again, I mentioned this in the morning show with you guys that the Fed is going to, really talk about inflation coming down in a very linear fashion towards their 2% target, which is exactly what they essentially want us to believe, right? That's what they're trying to instill in market psychology and consumer psychology, that they have everything under control, and that inflation, while it's high right now, they're essentially still saying it's transitory without actually saying it's transitory, talking about inflation moderately coming down in a steady and consistent fashion.
Yeah, we'll see. I mean, again, we'll have to wait for the words that Jerome Powell actually uses.
Have you taken a look at the new dot plot, Caleb?
No, I haven't. I saw a post on Twitter about it, but I didn't pay too much attention. What's it saying?
Smay, if you go to my stream, if you go to everything okay over there, Smay?
The audio cut out for a second.
Yeah, Smay, if you go over to my screen, Caleb can then see the new dot plot. So this is if you're looking at my screen, FOMC participant assessment of appropriate monetary policy, midpoint of target range or target level for the federal funds rate. And you can see down here, you've got the dates. So we are in 2022, and then the next set of plots is 23, 24, so on. So they are thinking that in 23, their funds rate could be potentially, what is that? That's 475 basically, and that's even above that line. Each dot represents a board member predicting where the rates should be, like what they would vote for the rates to be at that point in time. So, Caleb, have you been able to look at these dots, and what are they telling you?
So I'm seeing it now, and it's essentially telling us, we talked about this again earlier this morning, that their terminal rate is likely to peak in 2023. Obviously, we have a bit of a dispersion here, but we could probably say that the median estimate is basically right around that kind of like 4.6, maybe 4.7% range.
Yeah.
And, I think that's within reason. As of today, right, we're now at what? 325 on the upper bound? Is that right?
Ask the question again. I'm sorry.
So the federal fund target rate right now, they just increased it by 75 basis points. Aren't we now at 3.0% to 3.25% on the target Fed funds?
Yes,
right.
We are.
Yeah.
Okay. So essentially getting to, let's just call it 4.5%, indicates that the Fed is still planning to raise rates by at least 1.25% through 2023. That's no surprise, right? Like, again, even if they do 75 basis points in the next meeting or 50 basis points, they're still planning to raise rates. They can this is essentially pricing in that they're likely going to be doing 75 and 50 and then maybe another 25 and then be chilling.
Yeah.
Unofficial term, right? They're
Right.
just going to be chilling there after those rate hikes, but we'll see how that evolves.
Right. Yeah. So, yeah, I mean, I will honestly say it's kind of bullish. You could see how much more disagreement there is in 2024 back on my screen. 2024, there's a much bigger range. The board members are a lot more undecided on where that federal funds rate should be. Next year in 2023, they're all pretty lockstep around that, like what Caleb was saying, around that 4.75, 475 range. But if you look over in 2025, they're all kind of assuming it's going to come back down, kind of staying in this downward trending channel. But then there's a board member up here who's saying it's still going to be at 4.5. So we got to hold out there. It's kind of interesting, but yeah. So that's the dot plot. As Caleb mentioned this morning, there's only so much stock you can really put in the dot plot because they get proven wrong all the time. But it's that they still publish it for a reason. This is in their official PDF that dropped at the same time the data dropped, so it's important to take a look. But
I think if I can make one additional comment about what you just said, is it is very interesting to see that wide variance in 2024 interest rate expectations. And as you kind of pointed out, we continue to see that dispersion in 2025. And then obviously for the long run expectations, they're right around that kind of 2 to 3% range, if you will. The funny thing is, if we start to get into an environment where we actually do see the CPI continue to decline on a year over year basis, while the Fed funds is maybe above 4 or maybe even, let's just call it 4%. And, the CPI starts to dip below 4%. We officially enter, unequivocally into restrictive policy, beyond the neutral rate, right? Like there's this whole conversation is what is the neutral rate? People are saying, how the hell is the Fed, tightening with interest rates at, where they are right now, let's call it 3 to 3.25. But we have a year over year CPI rate of change of 8.5%. How is that restrictive? But that's a conversation for something else. But if we do get to an environment where the Fed is basically telling us to continue to expect a high Fed funds rate, if they are correct in their assessment that CPI will continue to come down, this is also telling us something very key, which is that we are likely going to be in a very restrictive environment for a long time. So I think the market might be digesting this data that we're looking at for the dot plot and coming to that realization. Tighter for longer, right? That's the key aspect here, which is why it's very likely that assets are selling off today.
Yeah.
We'll have to keep it on. I think what we're really going to be looking for is words. We talked about it this morning on Coffee and Crypto Live in the morning show, the traditional show. We're looking for the words from Jerome Powell. What does the future look like? And again, I think that, let's go back to the charts. We're going to look at a couple charts here in just a second, but I want to start with Bitcoin. There's a little bit of a pattern going on here over the last little bit, ever since a couple days ago. We had a descending level of resistance. We had an ascending level of support. This is what we call a symmetrical triangle pattern. This morning we did break out of it, and we kind of retested that. What we saw happen over the last hour was a shoot up and then a shoot down all the way below it. This happens with patterns like this. Continue to keep your eye on this. Just so you guys know, a lot of people knew 75 was coming. Also, these dot patterns, these patterns that you were talking about predicting what the future looks like, we will not know anything different until Jerome Powell comes and speaks. So when you're looking at this price action, you're trying to factor out why did the price get so volatile here within the last 20 minutes. It has a lot to do with what people were expecting and shaking people away. Again, we knew 75 was coming, was the bullish predictor. 100 was the more bearish one. Why did it shoot up and then drop? Because if everyone thinks they're going to buy, this is a great time to take some profit and to short the market, and then you can steal some liquidation from other people. But watch it then fake out, go back the other direction. We predicted it this morning. Get ready for volatility. So nothing has changed. Nothing has gone against the prediction. And unless Jerome Powell comes out and acts like we're headed for doomsday. If his words imply doomsday, if his words imply that the Fed feels like they're behind the system, they cannot get this done, inflation is just ridiculously out of control, whether or not it is, we're asking, what does Jerome Powell make it sound like? That will determine if we end up going to rally. That'll determine if we end up going down. Let's look at a couple other coins and see how they reacted. Most of them, I'm going to give you a spoiler, pretty similar. Ethereum jumped up, shot all the way up to 1,410, went and dipped all the way down to 1,300, give or take, 1,304. We're now hovering back around 1335. So kind of came back to the middle just like Bitcoin did. On Cardano, let's look at a couple of these big ones. Cardano did not really shoot up at all. Cardano had a little bit of rally up to 45 cents, 0.35, and then dropped all the way down to 42.5, and now we're sitting back up at 44. So Cardano actually kind of did something different, whereas Bitcoin and Ethereum had nice little shoot ups to almost fake out some of the bears, and then came back down. Cardano didn't really have that much of a rally. It had pretty much just a straight drop. Some other ones, some big ones we've been talking about recently. XRP is more in the green, so there's an outlier on XRP. You guys know a couple days ago we peaked. We came up above 40 cents, getting all the way to 42 cents. It had a little bit of a drop down here to 38 cents, but now is sitting back up at 41. So XRP is loving this news. Let's look at Solana, another coin. It's kind of not really explosive to the upside, didn't necessarily have crazy drop. It shot all the way up to about 32 cents, dropped back down to about 30. So we'll keep our eyes on these coins. Any other coins you guys want to look at, or you feel like that's good enough for now?
Did you go over Atom?
I did not go over Atom. That's not one of the ones I have there, but I can do that for sure. Atom USD. Let's see what Atom USD. Atom kind of had a similar response as Cardano, where it didn't really have that much of a rally. Rallied up to $14.51. Fell all the way down to 13.6, $13.60, 61 cents. It's now hovering back up around 14. Did you have any thoughts about Atom? How did you think Atom would respond any differently than the rest of them?
I not necessarily different than the rest of them, but I have noticed that Atom has held up remarkably strong relative to other cryptos, especially since June. They've just continued to kind of be in an uptrend. I think they got as high as like the 16, 17 range, and now they're back kind of in that 14, high 14 range. So, some investors and traders in particular really like to look at something called relative strength, basically. And, I guess, we're not seeing too much of that today, I suppose.
I've just discovered something. So if you go to my screen really quick, Smay, it's so awkward the way that CNBC has set this up. But there we go. This article has shown what has been removed, what's been changed about the statement from the Federal Reserve. And one of the big things is the statement reflecting supply and demand imbalances related to the pandemic, higher foods and energy prices, and broader price measures. On my screen, you can see they've crossed out energy prices. So energy prices have been omitted from what they are considering to be contributing to inflation. So obviously we knew that, but that's interesting that that's actually getting officially reflected in their in their statement there. And then, it goes on to talk about the Russian war against Ukraine and different things there. But so that's been changed. And really, looking at this whole statement, not a whole lot has been changed. You get, obviously, the rate of hike is going to be different. And then the point of modest growth, there's some changes up here in the first sentence. But the big one here, I think, is that they've omitted energy from the basket of assets that are contributing to inflation. Not assets, but factors, economic factors.
This was what? What is this document?
This is just the statement that gets dropped with the rate. So
okay.
it's coming from the federalreserve.gov. This is their press release, Federal Reserve issue FOMC statement.
So even though we knew that they were omitting the energy cost, but we didn't know it was official like this. They hadn't put that on the document yet?
Correct. And now I'm confused because I'm looking at it and it does say energy prices.
Yeah.
So why CNBC might have gotten something wrong, or I misread exactly what the guidance was on this. But yeah, I mean that's kind of a in the moment kerfuffle. We're trying to figure all this out in real time. But the big takeaway there is the energy has been, and Caleb and I talked about this last Wednesday. Energy has kind of really done what it needed to help out. A lot of other commodities too have done what they needed to help out bringing inflation down. Shelter has not done that, and food prices have also not done that. So getting shelter, getting those housing prices back down, which they should come back down, that will contribute to lower inflation prints in the coming months. But
gotcha.
Got to be getting close here.
We're about 5 minutes out, unless something changes. We're about 5 minutes out from Jerome Powell going live. Real quick, I did want to let you guys know that this afternoon stream was brought to you guys by Anthony Price, phenomenal CPA. Not going to say a whole lot about him because most of you guys know who he is. But if you are looking for a CPA, he is our CPA here at Coffee and Crypto. Taxes can be confusing. You're going to want help, especially with the IRS breathing down your back like never before. Check him out for a free 15-minute call in a link down below. Let's do some closing thoughts here for the next 5 minutes, or 4 minutes at this point, before we jump into the live stream of the press conference. Smay, you've been quiet. I'm going to get your take first. Smay, any closing thoughts? Do you change your prediction? Do you think lower than 19,800?
Yes.
All right, why? Give me a short little answer. We're rallying at the moment, but.
Because.
Good. Okay, nice, short, and sweet. T-Shroom, closing thoughts about this market.
It looks like it's equal. It looks like it's equalizing up into the speech. So price is coming back toward more of a neutral stance.
Yeah.
For this hour candle at least, and it'll be really interesting to see how it will shoot up and down all the fireworks, as Caleb said during the speech. But I'm going to keep my short position. Obviously, my long position in Bitcoin much larger. Just doing a fun little hedge. Don't try this at home, kids.
Don't try this at home. Yeah. What about you, Caleb? And I want you to go into detail again what you think, having watched the price, all this information we just talked about with what the Fed's releasing, but what they took into consideration. What are your thoughts about not only what the price will do over the next 30 minutes, but also what are you expecting from Jerome Powell?
So no surprise in terms of the actual announcement and the data. I think the only surprise that I'm having so far is the significant downward pressure that we're seeing in the equity markets. Obviously, Bitcoin and crypto has sold off, but interestingly enough, it seems to be holding up stronger than what we're seeing in equities. I think one thing that I do find really interesting is I'm looking at that CME Fed funds futures tool. And right now they're pricing in a 78% chance of a 75 basis point rate hike in November, on November 2nd. They're putting about a 20% chance on a 50 basis point rate hike and roughly a 2% chance on 100 basis points. So that's kind of our starting point, if you will, for where the market may continue to go over the next month and 2 weeks, if you will.
Yeah, so this time it's not 2 months. It's going to be about a month and a half before we get more numbers. That is interesting. So that makes you kind of actually, even that number, that kind of helps affirm where I'm sitting right now. I think even if I'm wrong about where we're at 3 p.m., I still think that this is going to have a little bit more of a bullish rally than it will a bearish. And even with that being said, the future, they're already starting to predict that next month the wrestling is going to happen more between 75 and 50 than between 75 and 100. To me, that marks, again, the feeling and the sentiment in the space at the moment is still that we have, again, as long as we stay aggressive with 75 basis points, we have control. That's all we need. And it's one of those things. I'm not saying 75 is great. I'm not saying it makes everything better. But when you're used to it, that's where the markets move. The markets move based off of something changes the status quo. And if the status quo is 75 basis points, if everyone is just anticipating and ready and expecting 75 basis points to come each and every single meeting, then we're going to actually respond by just going with the status quo. And anytime we get anything bullish in the space, we'll actually see some bullish action, and bearish vice versa. Are we ready to go?
We're ready to go.
Here we go. We're about to jump in. We will be quiet, and we will see you guys here in probably about 25 minutes, 20 to 25 minutes from now. Have fun listening along with us.
It switched screens, but he has not walked up yet. So
Okay, so
Okay,
we're
we've got a couple more minutes.
Oh, that's good to know. All right, well, that was awkward.
Looks like a
awkward
good
transition
healthy
there.
crowd there. Good turnout.
the stream started, but he has not walked out yet. So I
Yeah.
will
We
tell
have
you.
Nick.
when
We
he
have
wa-
Nick Timoreos
Oh,
right
there
there
he
in the
is.
front row.
Yeah,
There he is.
good
Coming?
looking head.
Yep. There's.
All right,
old
now we will
Jerome.
see you here in about 20 minutes.
All right, see ya.
Good afternoon. My colleagues and I are strongly committed to bringing down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Rachel.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So You're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also, do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about it in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see, at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So that's how we think about it.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision. But the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
But how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
There you go.
All right, there we go. We're going to cut it right there, and we're going to break this down. A lot of good stuff. We went longer with them because the questions were a lot better in this meeting than in other meetings. But, chat, what do you guys think about all of that? Let me know. Caleb, I think, is back in. I'm going to start off with you, Caleb. Give me your, because I got to hear T-Shroom's thoughts and Smay's thoughts throughout the whole thing. What are your thoughts about what you just heard for the last half hour or so?
I'm still kind of digesting things. I think Powell, let me say it this way. I think that the market perhaps expected more hawkish comments than Powell actually gave. Yeah. With that being said, his comments and the Fed policy stance is still historically hawkish. It's just less hawkish than the market was anticipating. And so since Powell started speaking, we've seen risk assets rally back substantially. The NASDAQ is up over 1.2% now on the day after falling more than 1.5%, or after being down more than 1.5% on the day immediately following the release of the FOMC policy decision. So we've had a significant and volatile condition in the market over the last hour, right? Generally, he just reiterated a lot of the same stuff that we've heard consistently over the last month and a half, which is a strong resolve from the Fed to bring inflation back down, consistent messaging that their number one goal and intention is to bring inflation to that 2% long-term target. I was definitely interested to hear some of his comments on the economic side of things, particularly talking about growth running below trend.
Yeah, that was weird.
Which is obviously, I think, expected, right? But I thought it was interesting for him to, reiterate that they're even expecting growth to remain below trend in 2023. So as we kind of continue to be in this economic environment that is very anemic, but we still have inflation historically elevated, again, right? It's like the biggest risk that the Fed is facing right now is stagflation. He continued to say throughout his commentary that they are trying to bring supply and demand back in line, right? My personal phrase for that had been that they are trying to re-equilibrate supply and demand at a lower market price. And considering that the Fed can't control or influence supply directly, they're forced to try to artificially suppress demand. And so that is a very significant risk for the market overall. I'd love to share one thing with you guys, which is something that I posted a couple of days ago. It's just a very simple economics chart. But what we're looking at right here is a natural kind of supply and demand curve. Nice. And if we think about the Fed trying to create a soft landing, but running the risk of incurring an actual recession, it's very possible that we have supply fall and demand fall. So we get a shift in supply from S1 to S2 and D1 to D2. And we can see that at our initial starting point, which we could basically say is today, we're operating here at Q1 and P1. But in this particular environment that I'm sharing, which is that both aggregate supply and aggregate demand decline in a recessionary environment, it's very possible that our price equilibrium remains where it is today, which is essentially the Fed's worst case scenario, which is a stagflationary environment. That's all I wanted to share.
Yeah. All their efforts don't actually move price.
Correct.
You know, I thought there was a lot of interesting stuff there. You know, real quick before I throw it to T-Shroom, Smay and T-Shroom do get to win. I should have not given you guys the
so
500.
competitive.
I am very competitive. At the time that we made the bet off screen, the price was 19,300. I should have just said over under because T-Shroom's point was he thought the price was going to go down. I should have said 19,300. But I spotted you 500. We literally got all the way up to, during that meeting, I don't know if you guys are watching price, we got all the way up to 19,793. We were within $7 of the line. But you guys did win that. T-Shroom, what are your thoughts about what you heard? And I'll back clean up.
So my thoughts about what I heard. Well, actually, I have a question for you, Caleb. When he said growth to stay below trend, he's referring to GDP there?
That's correct.
Okay, that's what I thought. I just wasn't 100% sure. But okay, so that does make sense. Really,
if I could clarify
go
something
ahead.
on that point, in macroeconomics courses that I took in college at UCSB, one kind of loose definition for a recession is growth running below long-term trend, right? Which essentially shows somewhat of an anemic level or lower than expected growth relative to historical norms.
Gotcha. Okay. So almost like it's GDP's below a moving average.
Yeah, that's a way to think about it.
Yeah. So one thing that I didn't know that they did that Jerome was quoting was inflation expectations well anchored. He mentioned that twice towards the beginning of the statement and in some of the answers, which to me signals something that I'd never really thought about before. It's almost like they're running polls to see who cares about the inflation, how they care about how inflation is perceived by, I guess, the average consumer. So not just what is the inflation rate, what is it projected to be, but how is the average suburban mom, the average, urban father thinking about inflation in the future? Do they think it's going to go up? And I think that's a really interesting piece of the puzzle that I had not considered before. Obviously, those kind of perceptions can trickle into the labor market, especially on a multi-year time horizon, but they can also obviously more immediately trickle into spending habits and spending behavior changes. So Caleb, did you know much about that, or Tim? Did you know? Are they running polls, or are they sourcing that from other existing polls?
I have no idea where they're getting that.
And am I even interpreting that right, Caleb? Have you heard about that? Did you hear? Were you
I think just generally, I mean, they have a lot of business connections, and I think businesses might be engaging with their customers, particularly small and medium-sized enterprises, to try to understand what the pain points are for their customers and essentially how to try to get more demand from their customers. But I think as it pertains to the Fed looking at inflation expectations, one of the easiest ways to do that is just looking at the break-even inflation rate. You can even look at tips and what the yield is on those. And so the Fed is getting live feedback specifically from the bond market. So it's not really so much from individual consumers, but is generally representative of how the bond market views consumer expectations, right?
Gotcha.
And so with the bond market being considered smart money, that's definitely something that the Fed is going to keep their pulse on. And we have seen 5-year inflation expectations via the 5-year break-even rate fall to the lowest level so far in 2022. This just happened yesterday. I'm not sure where they're at exactly today, but it's very clear that inflation expectations have been well anchored. And Powell said that, that's not reason for complacency for them, but it's certainly something that they see as working in their advantage. And he's definitely right about that.
Yeah.
It's really interesting. Really, a lot of things came out. Something that when you're talking about supply and demand, he's talked about before, there's just way too much demand, not enough supply in the chain. So lowering when it comes to just goods and services, you got to lower the demand to match the supply. But then also when he's talking about jobs and he's talking about that's where he's talking about lowering supply, because right now, I don't know if you guys have gone around and looked, there are still signs everywhere. At least there definitely is here in Gainesville, and from what I understand, other places. There are certain people losing jobs, but there are signs on almost every street corner saying still hiring. You drive past your local McDonald's, they're telling you how much they're going to pay you to come work there. So the job market at this moment is a little too strong numerically for there to be too much pressure there. So I think that's something that stood out to me he was talking about is making sure that is something that's big to him. Watching jobs and watching the unemployment level. Not that he ever wants to see and never wants to see a high level of unemployment, but at the moment, there's just not enough unemployment for there to be enough pressure to keep him from keeping those levels high. Here's the other one that I think is really big, really, really important I took note of, is that he specified. All right, we got two more interest rate hikes for this year, November and December. He specified that there's a lot of conversation that could be sitting at 125 increase. Let's just do some quick math. 75 plus 50 equals 125. If he did 100 basis point, that would go all the way to the next one could only do 25. Here's the thing to remember.
You're 50.
No. If you did 100 basis point next increase, you don't have to do 25 in December to make your 125. What I thought was interesting was when he pointed out that there's actually certain individuals saying that only needs to increase 100. So in that case, we're talking about maybe 250s, maybe a 75 at 25. Maybe you just do one in November that's 100 and go ahead and leave December blank. It's going to be really interesting, but to me, that actually stood out as bullish. I think that gives us a great target in mind. We're looking the rest of the year, and he specified he needs to see a lot of data change his opinion on that. But as a whole, the Fed is sitting here looking at, by the end of the year, they want to increase it by 100 to 125, which means currently, if we're sitting at the 3 to 325 range, they're looking for either 4 to 425 or 425 to 450 by the end of this year. So keep your eyes on that. I don't think anything's going to change that. He kind of went ahead and let us know what the future could look like, but we don't know which months will have which numbers. By the way, speaking of things he answered, how about the joke he made?
Yeah, that was funny.
The joke about he should know better than answering the second question. Of course, the second question was alluding to what are you going to do here in the next couple weeks. Do you think that has a lot to do, Caleb or T-Shirt, do you think that has a lot to do with the fact that, remember a couple of announcements ago, he alluded to, we're going to stay at 50, and there's no real reason to go much heavier than that. We'll need months of data before we really get aggressive. And then, of course, the very next month, they jumped it up to 75. That was the first 75 basis point rate hike. Do you think that he was maybe remembering that and regretting using words very strongly as if he was saying, I promise you we are not increasing rates next month, and then just went ahead and did it? Or do you think he's alluding to something else? Was it just a joke in general?
Caleb, you can go ahead and take that one. I'm not really sure.
I think it was an offhanded remark. Steve Leisman, who was the reporter who asked the question, has generally been quite tough in terms of the questions that he asks and really trying to kind of hold Powell and the Fed over the fire in terms of the extent of his question. And so I think just generally speaking, he has asked Powell tough questions in the past, and so he was just making a remark about Leisman's point. But I think generally you are right as well that, Powell has, I think, learned a pretty significant lesson over the course of this tightening cycle. Yeah. And their policy has started to reflect this, at least in terms of their rhetoric, that they're giving themselves a wide slack and degree of flexibility to make new policy decisions or adjustments to their policy decisions based on new data, and they're not beholden to a specific decision as of right now.
Yeah.
Yeah, I mean, that's my interpretation. I think that he's been very careful since that announcement of not really giving us too many promises. But again, I'm looking at this announcement. Like the thing that I would say stuck out the most, because that's the question. That's what we talked about prior to him going up on stage. We talked about, all right, we knew 75 was this one. The real question is, what do the next couple look like? And the price can go ahead and start baking that in. So whether we see a 75 and a 25, two 50s, a 75 and a 50, or just 100 and then a 0, we know that by the end of the year, their more aggressive goal is ending at 450. 4.5. The more bearish one, 4.25. So we have something now. The market can kind of work on with that expectation. There's really no chance they're going to go lower than that. Things aren't going to get better in a hurry and all of a sudden them slack off. We can now start pricing in and analyzing. More than likely, I would say we're probably going to see a 75 again in November, and then let them go light and decide do they need to do 25 in December or a 50. We'll see how things develop, but I'm very much expecting, based off of, I know we saw the predictions already before the show or before the announcement, that 75 basis point probably is going to keep high predictions for a while unless something changes.
Yeah.
Well, let's go ahead and get our closing thoughts here, and we'll wrap up today's stream. T-Shroom, takeaways from this show. You still feel good about the concept of it going down with your short position, or do you think there's room to the upside now?
Right now, I don't. I think it's going to continue to go down, but I'm about to show you guys reasoning for the opposite. So, Smay, if you'll go to my screen really quick. So I've pulled up the last two, how the market, how Bitcoin reacted to the last two decisions. So this was June 15th. This giant green spike right here was at 2 o'clock when they dropped the news, and it did a very similar candlestick to what we have today, where it made a very wide range on the hour, and these are hour chart candles, and then it settled somewhere in between, and then the rest of the trading period up until the next day, the next morning, like 12, meaning like the very beginning of the next day, it traded up, and then it faded lower, back down to where it was the previous day before the rate decision, before that big 2 p.m. spike. And then the one in July, so that was June. This one is July, and you can see again a big spike, and it got bought on that, and it took several days. It took a couple days before it faded back down. Now this one was in a pattern, as you can see here, so it was a little bit easier. It may have been beholden to some technical analyst forces, but I thought I'd just bring that up. So my short position is pretty illogical, but so far it hasn't panned out to be all that much of a negative. Don't go now. You can leave my screen. I'm going to see if I'm at a loss. Yeah, I'm at a slight loss, but I've DCA'd on it since I've been trading it. So and again, it was kind of just for fun to see what was going to happen, but I think I'm going to hang on to it. I think I'm going to hang on to my biddy till tomorrow, just because I won't incur the same day buy and sell trading on Robinhood. So I'll sell it tomorrow early, and hopefully I don't really regret that decision. But overall, I would like to comment. I feel like Jerome's tenor was very balanced. I feel like he answered all the questions. I mean, the fact that he got some brevity in there, a little bit of humor, that tells a lot about where his head's at. I just got the impression that this one was easy for him. I'm not exactly sure why, but I feel like he kind of has met his stride, and I think the reason is because he does see the light at the end of the tunnel, and that's bullish, obviously, but I'm going off of just kind of the tone. I felt like he was very comfortable, and honestly, I was a little bit impressed. I was like, this guy is kind of in control of the economy for a moment. All the conspiracies faded away, and I was like, I just want to believe in Jerome. So that that was another takeaway I had. I felt like he was very professional today, very calm, cool, and collected.
Yeah, good take there. T-Shroom. Caleb, how about you? What is your takeaway? What is your thoughts moving forward?
I'd echo everything Taylor just said. Again, this does kind of continue along the theme of the Fed showing its resolve, flexing its muscle, but acting in a very logical and concise manner. He acknowledged the risks. He acknowledged their goals and reiterated them. He's very clear about what their intention is, what they're trying to do, and the environment that they're trying to navigate in right now. So objectively, he was very objective, right? And I'd like to just add one more thing to the comments that T-Shroom just shared, which is market reactions following the Fed meeting. So historically, here's what we tend to see in terms of the day of the Fed's decision. So typically on the rate hike day, which started in March, we've seen markets celebrate to the upside.
Oh, cool.
The thing is, the next day after has been quite brutal, right? So again, focus on March and after, because this is actually when we started to see the rate hikes. We've seen substantial declines, except for the July data, right? So that's definitely worth pointing out. And then we could take this a step further. If we look at the 3-day percent change, so this is measuring the day the close the day before the FOMC meeting, so the equivalent of yesterday, through today, tomorrow, and the next day. And so what we could see is that over time, and specifically over these last couple of meetings, we've seen a negative number here, a negative number here, positive number for the first rate hike back in March, and a positive number for the July rate hike meeting as well. So kind of a mixed bag, but I think generally speaking, what this does show is that we should expect to continue to see heightened volatility in this environment. So that's one thing that I just wanted to kind of complement the analysis that you showed there for Bitcoin, which I thought was very intriguing.
Yeah, and I'm going to go and wrap this up. I'm in agreement with what you just said here, Caleb. First of all, I said that before we even went live. I said in the live show this morning, if you can expect nothing else, expect volatility. Go to my screen here real quick, Smay, and we'll look at the chart, and then we'll wrap up today's stream. We've already been volatile. I mean, if I go down to the hour chart, I showed you what you got a piece of the 4-hourly chart where we got a nice little candle spinning top going. Got a nice wick above it, got a nice wick below it. The question is, what's going to happen after? Expect a lot of volatility in here, but expect some things to clear up. The reason why I still think we're moving bullish is because we now for a while have been in this little, I'll go actually all the way out to the daily chart, where we've been in this little descending triangle. And whether or not we're going to break down and go crazy far, we have yet to know for certain. But I do expect, and it would make a lot of sense when we're looking at volume, we're looking at even if we were to pull down and do our Fibonacci retracement, which I'll go ahead and pull up for you. I am still expecting, based off my HODL trophy prediction, which is maybe we're going to hit it too late, maybe we won't get there, but I think that we could see the price easily bounce up here towards at least 20,500, if not putting closer. Maybe we spend a little more time, we draw it out, but watch us get back up into this range. Watch us come back towards this box that would stay in line with that descending level of resistance, and then Bitcoin has a decision to make. Does it want to go ahead and reject off this line and come back down to the flat level? Do we go ahead and break through? Do we go one more time and then break through? There's a lot of questions at stake, but right now the recipe that we have cooking is bullish action for Bitcoin over the short term, and the decision will come later. But Jerome Powell, like I said, I think he got to do exactly what I predicted for the first time in a long time. He got to ride out like a knight on a white horse and save the day with yes, we're doing 79 basis points, but we got a bright future. We can still get this done. Yes, there's some troubling times, but trust me, I'm your man. I think that's how a lot of people kind of interpreted that, whether we did or not. That's what his stage got to do for him. And because of that, I do expect a little bit of a relief over the next couple of days with the stock market, with Bitcoin. Let me know in chat what you guys think. Thank you so much for joining us in this afternoon live stream to cover the FOMC. Make sure to smash that like button on the way out. If you are new here, subscribe to the channel for more content. In case you didn't know, every morning we go live at 10 a.m. Eastern Standard Time with Coffee and Crypto Live. You don't want to miss them. Guys, we will see you in the next video. With that being said, peace.
Oh, I got a real good feeling.